Alright everyone, my name is Winfried Heinrichson and I'm a lecturer at CBS International Business School in the beautiful city of Cologne in Germany. Today we'll have to talk about journal entries, which means how to prepare debit and credit entries after understanding the business transaction. Again, I assume that you have some basic understanding of balance sheets and the income statement, and if not, please check out my introductory videos on financial statements. The links are in the description. As I pointed out in the previous video, the journal entries reflect the changes in the balance sheet affected by the business transaction. But I didn't go into details. So now we have to look a little bit closer into the details. There are only 4 distinct patterns of changes to the balance sheet affected by a business transaction. Let's look at them real quick. There are some business transactions which only affect the asset side of a balance sheet. One item increases and another item decreases. For example, if a customer pays an outstanding invoice, then the receivables will decrease and cash will increase, all of that by the same amount. The second one only affects the right side of the balance sheet. Again, one item increases and another item decreases. For example, if a company did not yet pay out a salary that was due, then it's still an expense, reducing equity. But it's also not yet paid, and that makes it a liability. Therefore, the liabilities will increase. We have then a salary payable, both of which, again, by the same amount. The third type of a business transaction creates an increase on both sides of the balance sheet. For example, any purchase of an asset that was not yet paid for by the company, which means it was bought on credit terms, increases the assets, whichever asset was bought, and increases the liabilities, the trade payables. Likewise, any loan that was taken increases the liabilities and increases the cash position or bank. Finally, the fourth type is a decrease on both sides of the balance sheet. For example, any redemption of a liability, any payment of that liability, a repayment of a loan, a payment of a trade payable, a payment of a tax liability, or a salary payable, decreases the cash or bank position on the asset side and decreases the liability by the same amount. Please observe that with the first 2 patterns, the balance sheet totals stay unchanged. With number 3, both balance sheet totals increase, and with number 4, both balance sheet totals decrease, all by the same amount. We come to our first example. A customer pays due invoices, let's say for 20,000. Now, due invoices imply that there is an existing receivable created by a previous sale. The sale itself is another business transaction. Here, it is only about the money coming in. Therefore, the receivables will decrease and the cash position, bank, increases. Naturally, the balance sheet totals are unchanged. How do we write this down in the accounts? How is this recorded in the accounts? If an asset account increases, it is a debit. If an asset account decreases, it's a credit. Now we have 2 asset accounts. The asset account that increases is the cash. So there we have the debit record. And the asset that decreases is the receivables. So there we have the credit record. So the journal entry reads, debit record bank, 20,000. Credit record receivables, 20,000. Second example. Company buys anything, a machine or inventories like merchandise, raw materials, shares of stock, any securities, anything that can appear on the asset side of a balance sheet. And that would be the important thing for now, paying right away. Paying right away, the cash position, the bank account, is being reduced. Let's say in our example, the company buys a machine and pays right away 5,000. The asset that increases is PPE, property, plant and equipment. So there we have a debit record. And the asset that decreases is bank. So there we have the credit record. Again, if we don't know, we remember for the asset accounts, anything that increases an asset account must be a debit. Anything that decreases an asset account must be a credit. So the journal entry reads, debit record, property, plant and equipment, 5,000. Credit record, bank, 5,000. Let's compare real quick what we just looked at. Everything that happened in the two examples happened on the left side of the balance sheet only. In the first example, there's money coming in. So bank is a debit record. In the second example, money goes out. So bank is a credit record. In the first example, the other asset, here the receivables, decrease. Decrease is in an asset account is credit. In the other example, PPE increases, and an increase in an asset is a debit. So though everything that happens here happens on the asset side, we have either debit records or credit records, depending on which of those increase and which of those decrease. Let's continue with the right side of the balance sheet. This second type of exchange pattern is a business transaction which affects only the right side of the balance sheet. Again, one item increases, the other decreases. An example could be, a company did not yet pay out salaries to an employee, but those salaries were due, which means the employee worked for it, but the salary was not yet paid. Automatically, this creates a liability for the company. And in accounting, a salary, paid or not paid, is an expense. The distinct feature of an expense is that it decreases profit, and since profit happens in the equity, an expense decreases equity. Keep that in mind. An expense decreases equity. That is what expenses do. So the equity goes down and the liability, in this case a salary payable, goes up. Here we can see that for liability accounts and equity accounts, anything that increases such an account is on the credit side, and anything that decreases such an account is on the debit side. So therefore, since the equity goes down and the liabilities go up, our journal entry reads debit record, salary expense 2,000, credit record, salary payable 2,000. Later we will see that the salary expense will also show up in the income statement. That is because all the revenues minus all the expenses make the profit of the company, and that's an extra calculation. But that is for later. The third type of a business transaction was where both sides of the balance sheet increase by the same amount. An example could be the company purchased an asset on credit terms. Could be any asset. Anything the company purchases which qualifies as an asset increases the left side of the balance sheet. In our example, let's say the company bought inventories, which can be merchandise or raw materials or office supplies. The German-speaking students should not mix up the German accounting word Inventar with the English word inventories. In an accounting context, the German word Inventar and the English word inventories are false friends. They look similar, but they do not have the same meaning, so watch out. So in our case here, the company purchased inventories on credit. This will increase the asset side, the inventories, and it will also increase the right side. Now we have liabilities, trade payables, which means the company will have to pay the supplier at a later date. The asset that increases is the inventories, so there we have a debit record. The asset account increases, so that must be debit. And the other account is a trade payable account. That's a liability, which also increases, but that must be a credit record. So our journal entry reads inventories, debit record 4,000, credit record, trade payables 4,000. The last example for now is the type 4 pattern, where both sides of the balance sheet decrease by the same amount. Let's assume the company now pays for the purchase of inventories from the previous example. When they pay the liability will go down, and so does the bank account. Two items in the balance sheet go down by the same amount. How do we record that? Again, once we have an asset account, which is bank, and that goes down, so that's a credit record. And the trade payables is a liability account, and that behaves in a different way. If that goes down, then we have a debit record. So the liability that decreases is the trade payable, so we have the debit record here for the trade payable, and for the bank, that's an asset account, we have the credit record. So the journal entry reads debit record trade payables 4,000, credit record bank 4,000. As a general procedure, let us establish a 5-step approach to prepare a journal entry. First, please understand the text describing the business transaction. Make sure you understand the transaction before rushing to any conclusions. Then, identify the items or the position in the balance sheet or maybe the income statement. Third, determine whether those items increase or decrease. Number 4, assign the debit and credit records. The debits are either an asset increase or a liability equity decrease. And the credits are either an asset increase or a liability or equity decrease. Then check the sum of the debits and the credits. When we have more complex business transactions, we may have several debits and several credits. But the sums of all the debits and the sums of all the credits for each of those entries must be equal. So that's it for now. Thank you for watching. If you want me to explain anything, just write something in the comments. I'll be more than happy to answer if I can.